Welcome to another video lesson from sketchnest.com. Today we're going to be talking about the FHA home loan and a little bit about how it works. So, what is the FHA? Why do you hear so much about FHA home loans? And how does it apply to you as a potential home buyer? So there's three parties involved here. The first one is the FHA, obviously. This stands for the Federal Housing Administration, and it's also part of the Department of Housing and Urban Development, or HUD. In other words, this is a branch of the federal government. Well, not a branch, but it's a department of the federal government. The other parties involved are the banks. These are primary lenders, such as Wells Fargo, Bank of America, your local community banks. They all fall into the category of primary lenders in this scenario. And the third party involved are the actual borrowers. And in the case of FHA home loans, these would be home buyers. So when someone makes an FHA home loan, they actually approach the bank directly. This is a common misconception. A lot of people think that they apply through the FHA and getting the loan from the government, but that's not how it works. So John and Jane here would go to a lender and they would apply to the FHA home loan program, assuming they meet all the qualifications for credit score, down payment, income, etc. They find a lender by going to the HUD website and looking for an FHA approved lender in their area. Just do a Google search for find FHA approved lender and you'll find the particular page of the HUD website where you can search for lenders in your area. So the lender gives the money to the borrower as in a normal mortgage situation. The FHA insures the lender against losses. So this is a big umbrella up here above the bank. So if John and Jane can't pay their mortgage anymore, let's say someone loses a job or maybe the mortgage is just unaffordable for them, they can no longer make their payments for whatever reason, the bank knows that it's going to get insured by the federal government through the FHA. What does this mean to John and Jane? It means that they're probably going to have an easier time qualifying for an FHA loan than they would a conventional mortgage. Maybe if their credit score is not perfect, they could qualify for an FHA loan. They can qualify with a smaller down payment, as small as 3.5% for an FHA loan. It's going to be hard to find that kind of down payment flexibility with a conventional mortgage loan. So it's easier qualification process, smaller down payment, a higher likelihood that they will be approved because the bank knows that the FHA is going to cover them for any losses resulting from the borrower defaulting. This insurance that the FHA gives the bank makes the bank more willing to lend money to John and Jane. Thus they have a higher chance of getting approved for a home loan. That is the basic relationship that takes place in an FHA scenario. If you would like to watch more videos like this, please visit us online at sketchnest.com. Thanks for watching.